Thank you for being here today on the panel or for a discussion on fundraising in the debt markets. I'll just like to do a quick introduction of our panelists and also thank them for being with us today. If you'll raise your hand as I read a little bit about you. First we have Bill Kirth, who's currently a Senior Vice President of Juno Financial. Bill has 30 years of experience in traditional banking, auditing, bank compliance, asset-based lending, factoring, purchase order financing, entrepreneurship, and private equity. Bill has previously worked for Zions Bank, First Interstate Bank, Wells Fargo, and GE Capital.
Cover all the big ones.
He has taught courses and published material on asset-based lending and banking for institutions, such as RMA, Lorman Education, and Goldman Sachs. Bill currently serves on the Utah chapter boards of the RMA, TMA, and ACG, as well as other boards and companies he has invested in. Bill also manages his own private equity fund, which currently holds equity positions in 5 companies. He's owned and sold other businesses during his career and has had extensive experience in financing both early stage, high growth companies as well as turnaround companies. Just a note about Bill, he holds a green belt in Six Sigma and a black belt in Taekwondo. I'd just encourage the audience to behave today as part of that. Phil Johnson, who is a graduate of Weber State and has a BA in economics, an MBA from the University of Utah. Phil has 10 years total with Zions Bank and Citizens Bank. In 1981, Phil started Anchor Financial, a commercial loan brokering business that specializes in lines of credit, factoring, SBA 7A and 504 loans, USDA business and industry loans, conventional commercial mortgages and equipment loans and leases, as well as dealing with credit unions, life insurance, and mortgage and finance companies. Phil brokers loans for all types of business and property types in Utah, Idaho, Nevada, Arizona, Colorado, Wyoming, South and North Dakota, and Montana. Also, then we have Steve Carlston. He's currently a Senior Vice President of Capital Community Bank, where he manages a commercial team and oversees commercial credit approval. Steve has over 20 years of experience in commercial banking, including lending, credit, cash management, leasing, and business development. Steve previously worked for Bank One, Zions Bank, America West Bank, and Key Bank. He is one of the state's top SBA 504 lenders and built a $100 million commercial lending book of business from scratch. Steve has extensive commercial banking experience in credit analysis, credit approval, loan structuring, loan underwriting, and customer relations. Steve has a BSEE and an MBA from the University of Utah, and Steve also enjoys skiing and running. I myself am Justin Hatch, currently the Vice President of ABL and Commercial Lending at Tab Bank. I don't have quite the experience as a lot of these individuals do on our panel, so we've got a great panel for you today. I've yet to publish anything really. Some of my greatest success is actually the fact that I'm a father of 6 children, a beautiful wife, so a family of 8. 5 of those have beautiful, long, flowing hair, thick, flowing hair. So I think the first thing I do publish is probably just going to be like on YouTube, maybe like how to clear a drain plug or a vacuum cleaner or something like that. But anyway, without further ado, we'll start our panel. We're going to, as we have a small group here, I'd like to keep it quite informal actually. And so rather than taking a lot of time and only leaving 5 minutes at the end for Q&As, questions and answers, I'd like you to feel free to raise your hand as one of our panelists might be discussing something or saying something that you actually want an answer on a little more immediately. Go ahead and raise your hand. We'll allow for those questions along the way. But to start, I have asked both Phil and Bill to start with some kind of opening remarks. First, we'll hear from Phil, and I've asked those remarks to kind of be kind of focus on the current state and influences of the market, and then from Bill, who will share similar thoughts, but on kind of some of the future state and influence of the market. Phil?
This is an ugly-looking microphone here.
kind of looks like something a doctor would use on you when you're in your 50s. But,
Oh, you really went there?
I wasn't going to go there, but I did. My name's Phil Johnson, as was said, and if you can go by the dates and things that Justin said, I've got to be the oldest guy in the room by probably 20 years. And I like doing what I do. I've been loan brokering for 37 years after 10 years of banking. I'm glad there aren't a lot of real traditional bankers in the audience, because a couple of comments that I make will maybe offend them. But I tell people the only thing that's more hormonal than your wife is a banker. Okay? And having dealt with banks and credit unions and life companies for many years, it's kind of true. You have to, depends on the day. And sometimes the luck of the draw depends on whether you can get your loan approved. Depends what's going on in loan committee that day, how everybody feels, what happened yesterday. But being more positive, the current state of lending in the state of Utah, I think, is very, very strong. Our economy is very, very good. My biggest concern about our economy is the national and international influences that come upon our economy. Some of us have been through a couple of recessions, major recessions. We just went through one 10 years ago. I suppose that we're in the longest recovery cycle that there's been for many, many years. What is it, like 10, 12 years now? And we've never had a recovery that lasted that long. So eventually, there's going to be a little bit of a downturn. I think in the state of Utah, we're in very good shape. We're a much more diversified economy than we were 40 years ago, 45 years ago when I got into banking. Back in those days, Kennecott, Geneva Steel, the universities, they were the largest employers. Now we've got tons of Silicon Slope, high-tech companies. We're very, very diversified. I remember 30 years ago when Kennecott went on strike, it affected the whole economy of the state of Utah. One company went on strike, and it had an effect on the total economy. So I think we're strategically in good shape. Financially, we're in good shape. We have lots of good banks and credit unions and lenders in town. And that's kind of this current state of affairs for business opportunities and for lending is very, very good.
Great. Thank you, Phil. Good morning, everybody. I'll keep this brief. The future state. Again, I remember as a kid going with my dad to the bank, and I'd get the free donuts. They'd give you a toaster or whatever. You remember those days. Some of you weren't even born yet. It used to be that your circle of influence in banking was your hometown, your city, and that's changed with the advent of fintech, the internet. Banking and debt in general has become much more sophisticated, much more global. There's many different types of debt financing, many hybrids, everything from straight factoring all the way to bank financing, all the way to hybrids like subordinated debt, mezzanine finance, convertible debt, and so on and so forth. So there's a much wider array, and it's just going to get even more so. Now you have the advent of MCAs, revenue-based finance, and we'll go into all that later on. But there's many forms of financing out there for a business that's really tailored for where they're at in their business life cycle and where they're going. I'm on many panels of the sort, and usually I'm talking to business owners, which is a completely different conversation. This is a much more sophisticated group that knows most of the terminology and vernacular. To a business owner, they typically know that there's a bank and there's equity and not much in between. So we educate them on, where your life cycle's at, what type of lending is congruent with your life cycle of your business. And with that, the business life cycle is much like a standard bell curve. Who remembers the standard bell curve in college? Anybody? That bell curve is like a business life cycle. You start from nothing, you end up growing. You're a mature company for a while, whether it's a year or 80 years. Sometimes they decline and die, sometimes they decline and are resurrected. But if you draw a line down the middle and go out one standard deviation, that's the bank's business. That's where banks reside. They've gone past the growth, they're not declining, they're kind of in that safe, just daily business, and it fits. We at this table are playing on both tails. The early stage high growth tail, the declining tail, that's where banks are uncomfortable lending. That's where they don't belong lending because of FDIC or OCC regulations. And that's what we're going to talk about today, is the two tails of a business life cycle and the different types of loans out there. So where's the future? Again, much more sophistication, much more global, and many different types of financing out there.
Okay, thank you. Steve, do you have anything that you'd like to add to both the current and future state of the market?
Push this.
Yeah.
Well, Phil, I don't think you have to worry about a job at Fisher Investments anytime in the future. You know, the thing I'd see in the market today is there have been a lot of various publications lately who have talked about Utah in the past 3 or 4 years as being anywhere from number 1 to number 5 in the best places to do business in the United States. One recent publication said that we are the most diverse economy in the United States. And I think that bodes well for everyone in any business, in any level of business, because at the end of the day, as Phil was saying, with Kennecott's strike affecting everyone, with all of the synergies and all of the things going on in our economy, it also benefits everyone and it facilitates everybody's success and everyone's growth. And I think there's a lot of opportunity in this marketplace at this time.
Okay, thank you. Again, as this can be a very broad topic, as broad as you all want to make it today, as Bill mentioned, you know, you have the banks, you have the equity, and then you have a lot in between. Again, go ahead and be thinking if you have those questions of, again, either the bank or the equity or anything in between. We'll take those questions here. But like to open this to the panel. This first question, as our audience thinks of questions, which are, what are some of the biggest unknowns and surprises you see as, you know, from companies when they're out seeking fundraising, again, through debt, equity, or the various sources that are out there?
I'll tackle that.
Okay.
Every time I meet a company for the first time, whether it's debt, equity, or whatever, I ask one question that kind of guides me down that trail. And the question is this: is this business a lifestyle company or is it an equity play? What does that mean? An equity play is I'm going to start it, I'm going to scale it, I'm going to sell it, and I'm going to exit. Lifestyle companies, I'm going to start it, run it, live off the revenue, hand it down to my kids, and be my legacy. That decision right there is going to kind of start you down the path of which way to finance. If you have an equity play, bring on a strategic equity partner. They can help you scale it. They can get out of it. No problem there. The flip side is you're giving up a piece of that exit. So you also want to supplement with debt. If it's a lifestyle company, I have a famous saying I love, and I'm in the business, on one side of the business of early stage high price debt. I'll eventually be taken out by either an exit or by a bank. And so I tell people equity is like a lifelong marriage, and I'm like a one-year fling. I'm in, I'm out, no strings attached. With equity, it's a lifelong partner. And I can't tell you how many companies I've been involved with that have what I call dead weight on the cap table, meaning the company's out raising equity. They don't really have strategic. They just take whatever cash they can get. They grab it. The company scales. It's very successful. And you've got this equity holder who holds a substantial amount of equity that's just dead weight on the cap table. They're not contributing to the company. They're not doing anything. They're just kind of go along for the ride, and they're going to have a great exit at the end. So make that decision or ascertain that decision of whether they're going to scale and sell it or be a lifestyle. From there, again, decide what the future is and what partner you have. If you're going equity, make sure it's strategic. Make sure you get along with them. Again, it's a marriage, and there's nothing more miserable than sitting in a board meeting with some, I won't use the term here, but some idiot shareholder who just makes every board meeting absolutely just painful. So choose not just the money, but choose the partner behind the money, choose their contacts, what they can add to the company as well as that. Or if the lending partner, make sure that they understand your business. Now, unfortunately, as an investor, I can give all the input I want. As a lender, they're restricted by lender liability. They can only help you so much with their business, and then you cross over that lender liability line. But make sure they know enough about your business that they can contribute more than just cash. And if you have a downturn, they understand why you had a downturn, and it can help you navigate to recovery.
Okay.
Question.
You answered a bunch of my questions, so I appreciate that.
Oh, you.
Tyler Ballas, Smart-Ship, we're a high-growth tech company out of Lehigh. We've been punting, we've been in business 3 years, raised a small equity round to kind of launch the product. To this point in the game where we've been punting, per se, an equity round. This is a pure equity play for the company at this point in the game. But we would like to raise debt. However, we're not an asset-driven business. We're a technology.
Right.
Banks
Yeah, I know, and I know your space well.
What recommendations do you have for a high-growth tech company
So-
that's not asset-driven to actually?
You're right.
solid debt?
And the thing about a company like yours, and I'm invested in a couple, I just exited a SaaS company actually, so in a SaaS company, if I'm correct, there are no purchase orders, there are no receivables. If I look at your balance sheet, you really have your money invested in your technology, a few computers and desks, and that's really it. And unfortunately, unlike a manufacturing or service company, there are no receivables. Here's what you have. You've got great contracts. I suspect that you're a subscription-based, contract-driven company, whereas you have your SaaS, you hand it over and say, here, you can use this. You're going to sign a year-long contract or multi-year contract. I'm going to bill you in advance, X amount, and that's your MRR, right? Your monthly recurring revenue. So I, as well as others, Silicon Valley Bank does the same thing. They'll lend on what's called a multiple of MRR, meaning under your contract, every month you pre-bill, they'll lend you multiple of that monthly pre-billing, which is MRR, or monthly recurring revenue. So that is a form of debt financing. Sometimes it comes with warrants, sometimes not. But that's a great way to scale without diluting your company. So I guess my question to you right now is, what's your MRR right now?
Just over 100,000.
Okay. I do that. I start at 70,000 MRR on up, and I'll lend you 3x MRR. So in your case, it'd be about $300,000.
We're going to turn the microphone off on Bill, because
What? No, sorry. Does that answer your question?
Bill and I have been friends for 30 years.
Bill wants the deal, it's good.
Yeah, he wants the deal, and Steve and I want the deal, okay? Steve,
Steve may not want it.
there are ways that you can do debt financing on a company that doesn't have a lot of assets. And Steve knows this, and I'll let him finish it, but the Small Business Administration, if you've got the right lender that lends upon cash flow and business acquisition, I'm doing a $5 million unsecured SBA loan right now for a company that's been around for 40 years, a service company. The CFO is buying the company, putting $1 million in. He needs a $5 million line of credit or a term loan, and the seller's going to carry $2.5 million. But we're getting a $5 million unsecured 10-year loan with a bank, 75% guaranteed by the SBA. Well, that prime plus 1%, prime's 5%, 1 over that is 6. That's a lot cheaper than getting money from Bill, so don't.
About a third.
Bill's expensive.
Yes, I am.
But Steve, do you want to finish that?
Yeah, what you're referring to is an SBA 7A loan, and they can be very effective and very efficient in a lot of different businesses. Going back to the surprise from the banker's perspective, I think that one of the things that I've seen in my career, and maybe some of the frustration that you're talking about with banks, is a lot of people, especially early in the business cycle in Bill's bell curve, go to a bank and they're looking for debt financing. But what they aren't perceiving or forcibly really aren't understanding is they're not really asking the bank for a loan. They're asking the bank to transfer risk from their business to the bank. And I think that's one of the areas where people get in trouble in traditional bank financing, is banks exist to facilitate your ability to do business. They do not exist to take your business risk. That's where other forms of financing, including equity, warrants, other things that Bill has discussed, come into play. And I think that's one of the reasons you've probably experienced some of the frustrations with banks, is with the collateral position and what you're looking for. It is a type of specialty lending. There are banks and there are markets for various different types of specialty lending, but they can be niche markets. And you may be talking to the wrong bank. The situation just may not be a good fit. So.
Does that answer your question?
It does, thank you.
Okay. Just by raise of hands, I mean, how many CFOs do we have with us in our meeting today? Okay. Just to add a little bit to that, I mean, typically, and to the question I mentioned is, what are some of the biggest unknowns or surprises as companies are looking? I mean, we work at TAB, work with a variety of size companies, but one thing I've noticed in working with customers throughout the year is, again, they come and they want money, right? But again, understanding, and as Steve mentioned, the caveats to that as far as, how much the bank wants to take on, the risk, the type of structure they had, is often discussions that we find ourselves involved in trying to help guide them in the direction that they need, what that balance sheet needs to look like, be it to get financing, from us or anywhere else. So any other questions on that topic from the audience or any other topic so far? Okay, yes?
Bill mentioned the economic cycles going up and down. We're in a long, prosperous time right now. But there are rumors of a recession coming. Obviously there is, but at some point, at which time you three in the industry that you're in will start tightening your lending and tightening your, qualifications and so forth. Are you seeing any of this tightening yet? What you see in the market?
Can I take that one?
If you're brief.
Yeah.
5 minutes, Bill.
What about my
5 minutes.
Leave my briefs out of this, Phil. That's called for.
In your briefs.
So to answer your question, I don't tighten up because I have the same scrutiny and control in good times and bad times. That's why I'm an asset-based lender. And so I really do the exact same blocking and tackling in good times and bad times. But I will tell you this. I concur. I think we're at the precipice of maybe another probably slower downturn, but at least a short recovery. One thing I'll tell you, and if I learned one lesson in the last recession as a lender and an investor, was I love to keep a very light balance sheet. I keep as much as I can off the balance sheet, keep it as an expense item. Why is that? With last recovery, we were doing really well. All of a sudden, revenue dropped in 2008. Well, a lot of companies had really heavy balance sheets, debt, fixed charge coverage, and they got caught with the pants down, and they got in trouble. They couldn't service the debt. They were servicing at this revenue, but not at this revenue here. And in loan structuring, it's the same thing. What I'm seeing now is a lot of what's called MCA loans. Do you guys all know what MCA loans are? Anybody? It's a merchant cash advance. They basically give you a loan, and then they hit your account every day, week, or month, irregardless of revenue. The problem is, if your revenue is high, you're okay. If revenue drops, you're still hitting your account up here. And so I love working with CFOs. Here's the reason. I'll take my loan, I ask them to plug it in a set of projections. I want to see if they can cash flow my loan as well as other loans. More importantly, if revenue is up and down, I want to make sure that the loan payment amount follows suit. You're not servicing a debt up here when your revenue's down here. And so an MCA term debt sometimes doesn't work for a cyclical company. Yet maybe a line of credit or something that will follow, your payments will follow suit with your revenue. And to your point, especially if we hit a huge downturn, those companies that are carrying a heavy debt schedule are going to be toast. Does that answer your question somewhat?
Well, let me add a couple things. Is that on? Let me add a couple things on that. First, economic cycles to a bank from a traditional lending perspective are not so much about the economy as they are about the individual company. In a good economy, there are plenty of companies out there right now that are struggling. And even in 2009, 10, 11, I saw a lot of companies that were doing extremely well. It was really predicated on their market position, what they did, how they did it, how their contracts worked. To me, and this kind of dovetails into what Bill said, the biggest risk that I see in the event of a recession for any company is that in any strong economy, companies grow, and they grow as quickly in most cases as they possibly can. Most people are very top-line driven and grow at all costs. The negative side to that, which Bill touched on, is in many cases they incur a lot of debt to facilitate that growth. And as long as they're growing, as long as they're stable, that's fine. In the event that the economy does slow and their revenues quickly decline by 30, 40, 50, 60% because of the slowing economy and the impact that it creates on them, that debt crushes their business. And that was really the biggest issue that we saw in 2008, 9, 10, was a company that was doing 30, 40, $50 million a year in revenue, loaded on $20 million in debt to facilitate that revenue. Suddenly, 1 year later, they're doing $20 million in revenue and they're trying to service $20 million in debt. So I don't know if I'd view the risk so much as forcibly economically sensitive, as much as company sensitive, and how changes in the economic environment could affect your ability to drive that top line growth and service that bottom line debt and profit line.
Okay.
Bill?
Okay. Thank you for the question. I mean, there is a reality there, right? I mean, to Bill's point, I mean, he says it doesn't matter to him, but we see it. We see bubbles. We see banks get in certain industries, get out. We see it in, oil and gas. Banks like to be in that a lot better during the good times and the bad. So we just do see those movements, and I would like to kind of go off of that question onto the next one, which is, when a CFO or when a company is evaluating a bank and looking for it, it's pretty easy to calculate fees and calculate interest and kind of that financial component. But the question along with that, some ideas or thoughts on how they really go about determining the best fit for them, considering things such as, structure, expertise, and or potential changes in the economy.
Before Bill gets his time in, I wanted to say something, okay? As an independent loan broker, one of the things I think that we offer is kind of a knowledge of who's on first and who's on second and who's on third. And not all banks and lenders are created equal. They all have different appetites and likes and dislikes, and some of those are based upon their previous experiences. If you find a banker that had a bad loan on a restaurant 20 years ago, he probably doesn't want to do another restaurant for the rest of his life, no matter how good it is. Steve's the antithesis of that. Steve will figure out how to make it work, but a lot of traditional bankers will just, have short memories. But one of the things that we offer is that because we are not a direct lender, we're a broker. When somebody comes to me with, say, a daycare center that they want to refinance or something, or buy a new gas station or build a hotel, we should know which lender, credit union, bank, life company, mortgage company is interested in that type of an industry. So it means we have to have a relationship. I have a relationship. I'll close loans with probably 10 or different financial institutions in a given year. I have to have a relationship with each of my lenders, just like I do with Bill. It's kind of a love-hate relationship, Not today. but one of the things that I think that you need to keep your options open, and just because you bank with one bank and have always done it doesn't mean that there are other lenders out there that may not do it. Years ago, if you're in banking and you left that bank to go to another bank in sooner than 5 years, there was something wrong with you, because banks were loyal to their employees and the employees were loyal to banks. That's totally changed in the last 20 years. Look at the number of banks these two guys have worked at for many years, for years. Lenders are not loyal to their employees as much as they used to be, and therefore employees are not as loyal to the banks as they used to be. And so therefore, I think having a good banker is more important, or just as important as having the right bank. If Steve Carlston leaves Capital Community Bank and goes to another bank, I would be willing to bet that 3/4 of his customers will go with him. His bank thinks that they bank with Capital Community Bank, but they really bank with Steve.
Phil, that's a very true statement. In banking, it's no different than any other relationship that you have in business. Build a good relationship with a good banker, a banker that has a strong skill set. One of the issues that we've seen in banking in the last 20 years, in addition to what Phil is talking about, is banks really don't train anymore. It used to be that most of the big banks had extensive training programs, and they would essentially mentor and train all of their young employees. That no longer exists. And so people do business with people. People don't do business with organizations, which really follows what you're saying. And find a good banker. Don't do business with a bank, because a lot of the big banks in particular, those employees are churning and following that pattern. If you don't have a relationship with the employee, you have nobody to stick up for you, nobody to look out for you, and you will stub your toe. Everybody stubs their toe. And when you do, you need them to be there fighting for you. You need their relationships and their connections to help protect you. Without that relationship, without that banker, the bank will do what's in the bank's best interest. And that banker has other relationships, has other networks and other connections that can also help you through those tough times. And so I think Phil makes some really, really good comments.
Just,
To touch upon that, well, let me ask this other question real fast.
it's yours.
So
Go
as
ahead.
CFOs, you guys have an important part of making that structural decision. Every time I do a loan, I like to work with CFOs and say, hey, listen, plug my loan into your projections. There's different types of loan structures, different types of loan needs. So if you're going to figure out the right loan for your company, take the loan, plug it in your projections, your uses of your cash, and the repayment schedule. It may be a term loan might be the best, or it might be a cash flow working capital loan. You don't know that until you plug projections in to see if you can cash flow that loan, as we talked about earlier. And so to make that structural decision, again, let the numbers do the talking. Plug it in your projections, put it in your balance sheet income statement projections, and see how the loan performs. That's it.
Just a couple thoughts to that. I think, too, as you play a role in, again, the finance of your company, those decisions that we've talked about, and that relationship building, again, having working with lots of customers every day, again, it's not that no news is good news. I think that mentality has to be thrown out. I mean, be in touch with your banker, know your banker. Again, the more you're communicating with them, keeping them apprised of your situation, be it good or bad, quite frankly, is good. Because, as Steve mentioned, they're the ones who are going to bat for you. They're the ones who are presenting you, your company, to the bank, and they're trying hard to work for you. Again, I love working with CFOs. I don't love working with new CFOs because oftentimes they don't get that component, right? They want to come in and make a big change and prove the company of why they hired them, but it makes it tough when you're trying to build, again, those relations that will hopefully last through, again, those downturns in the economy, individual industries, or whatever. Other questions that have come to mind that you'd like to ask our panel? Anybody? Nobody? Okay. Next question then. I'll get this one. What, maybe we've even covered that one. Let me move to another one. What are some of the similarities and differences when it comes to the various lenders in the market as they're trying to, again, we've talked about this a little bit, but as they're trying to make that decision, how do they go about gleaning or gathering that information?
You want to take that, Phil?
So I'm not sure I understand the question.
Well, we've talked about the variations in the market,
Okay.
right? And not knowing what maybe the various lenders have to offer. What are some of the best ways for them to go about and gather that information and find somebody who can help them in their next funding decision?
As I said, all lenders are not created equal. Talk to people in your industry. I've found over the years that most you that are CFOs or own companies, some of your best input for future decisions comes from your competitors or people that you know that are in the industry. Networking is more important today than it was 30 or 40 years ago. That's why an event like this is so important. But one of the things that Bill alluded to that I'll just finish with, and it's kind of related to your question. You can get a great interest rate from a bank, and it may be just enough money to hang yourself with. It may be a good interest rate with a low fee, but it doesn't get you from point A to point B. It gets you halfway in between. There's a good banker that just walked in here from Phoenix. I mean, he's been here, but he just walked in late. Tim Carlston, who does asset-based financing for a big bank out of the Midwest, but he's out of Phoenix. He does lines of credit. Wells Fargo Bank may offer you $1 million line of credit and you need $1.5 million, and they give it to you at prime plus 1/2, and you plug it into Bill's formula, and it makes sense, you know. Gee, I'm not paying very much interest, but I really need $1.5 million line, but they won't give it to me because they won't give me a high enough advance on my inventory. But somebody like Tim may charge 2 or 2.5 over prime, and so you look at that and think, that doesn't make sense to pay 2% more on $1.5 million than I could get it from my local bank. But if it doesn't do you the good that you need it to do, then it's not a wise decision.
If I can add to that, there's a saying I love in business, and it's, if you have a hammer in your hand, everything looks like a nail. You guys heard that? Many lenders have their product, and every deal that comes to the door, they're going to try and pigeonhole that loan into their product. What I love about Phil, and I work with Phil a lot, is that as a loan broker, Phil has all the array of tools in his tool belt. So when the loan comes in, he's going to put the appropriate loan with the appropriate loan tool, which is why he's got real estate, working capital, all the different loans. So if you just don't know where to go to a guy like Phil, and he will help guide you to the right loan. If you have an idea, every lender is different. And to Phil's point, it's not always the cheapest loan out there. Make sure the loan does what you need it to do. Make sure it gets you where you need to go, which going back to those projections, right? I sound like a broken record. Plug in your projections. If it's not enough, I don't care if it's cheap, it's worthless. But if it's enough, great, you want to get the best rate. But make sure over rate, you got structure and availability over rate. Rate is secondary to structure and availability. If you have that, then rate becomes more important. Steve?
Well, I'd add one more thing to rate. Relationship over rate. It's not worth taking an unknown over a quarter point when you know what you're going to get with someone else, even if they're a little bit higher. Again, if there's a problem, if there's an issue, that relationship is a lot more important than the few dollars that you saved. I'd also, talk to your friends, use your relationships, use your networks. People do business with people that they're comfortable with. And people that have good people that they're comfortable with are more than happy to share those relationships and those opportunities and networks with you. And, again, like Bill, like Phil, getting to know those people helps you to facilitate what your real end game is, and that is to grow and build your business.
Yes.
What are the big red flags for you guys that would cause you to deny credit to some of these startup companies?
You want me to hit that? Go ahead.
Just real briefly, banks, lenders don't like to finance somebody's first rodeo. If they don't have experience in the industry, somebody wants to start a motel and they never worked in one or they never owned one, that's not going to happen in today's market, even with the availability of plenty of debt money. So don't finance somebody. You're not going to get your first rodeo financed. You have to have experience in that industry or a related industry to be able to get a startup funded, in my opinion.
I think a lot of it comes back to what we touched on earlier, and that's transferring risk. And it really doesn't matter what type of capital, debt, or funding you're looking for. If at the end of the day you're transferring risk and the person you're trying to transfer risk to doesn't perceive that risk as compatible with what they're taking, then that's going to be a red flag. That's going to be a problem. In a traditional banking situation, banks want cash flow and collateral. They want a profitable business, and they want to be able to secure the loan so they can get out. As you move into different debt tiers, mezzanine, equity, different levels, those dynamics can change, but at the end of the day, the person that's lending or providing the capital has to see opportunity and upside also. And that, if they don't see that, then that really becomes your red flag.
And I'm a little different because I will do the early stage companies. And what I look for are a couple things. Number one, transparency. If you're hiding stuff from me and I have to find out elsewhere, we're done. Be open, give me the good news, give me the bad news, give it to all. Number two is knowing what you need, what you're gonna do with your money, how you're gonna pay it back. People say, I need money. Well, great, what for? Well, I just need money. Well, what are you gonna do with it? Well, I just need money. Okay, what specifically? What are you gonna do with it? How are you gonna pay it back? Know what you want, know what you're gonna do with it, know how it's gonna benefit your company, know how you're gonna pay it back. If you can answer those questions and you're transparent, I'm in, if it makes sense. But my red flags are really character. If you're withholding from me, I've got a problem. And knowing your numbers. That's why, again, I love CFOs, because if you know your numbers and they make sense to me and I can buy in, I'm in.
Can I add on that, Bill? Bill makes a good point there. There was an old saying in any type of lending, and they used to call it the 5 C's of credit. And the first and foremost of all those C's is character. And if the lender doesn't perceive character, it is the end of the line. So that is the most important.
Thank you. Okay, we have about 5 minutes left, so again, any questions now, or if you have one you want to think or have, go ahead.
How often do you see people going after equity capital when you feel like debt capital would be a better solution? How do you sort of evangelize debt a little bit?
You missed the first part, but I'll tell you right now.
I'm sorry.
No, you're fine, because I'd love to say it again. I love saying this. Oh, so I gotta do this here. I see more companies prematurely dilute, and it drives me nuts. And I'll have somebody come to me and say, hey, what's your rate? Oh, my rate's 15%. Well, I'm gonna go equity, it's cheaper. The most expensive debt is cheaper than the cheapest equity all day long if you're even remotely successful, all right? Does that make sense, everybody? It's painfully true. Premature dilution is one of the biggest errors I see in financing early stage companies. Now, there's time when it makes sense to bring a strategic partner. They've got money, they've got a great Rolodex. I can't believe they use that term Rolodex. You guys may know what that is, but they've got a great circle of influence. They've got either vertical or horizontal strategic. It makes sense. It's not free money, guys. I said it once, I'll say it again. Equity is a lifelong marriage. Debt is like a one-year fling.
You do both.
I do both.
And can I add on that, Bill?
It's legal in Utah.
Well,
The-
and sometimes,
Well,
sometimes the board oversight from an equity investor is as onerous or maybe more onerous than debt covenant.
It
Yes.
is, absolutely. And the only thing worse than that is dead weight on the cap table.
well, you have to make sure that whatever source of financing you pursue, it's the right fit. You know, it's no different than hiring a key employee. You can find a great, easy option, but if it's not the right fit for you, you're going to be swimming against the current forever. And there are situations where, fact is, I ran into someone today. We had a mutual connection in a prior company where they raised equity. They viewed it as a good opportunity at the time. The equity funder actually destroyed the company because their objectives and their goals were not aligned.
I was the CFO of a company called Orange Soda, and our equity investors practically killed us in Bridge Bank with a debt facility to kind of saved us.
I financed Orange Soda early on. JB, you remember that? Through debt, not through equity. I wasn't that guy, sorry.
Any other questions? I have about 3 minutes left. Okay, question. So with all the options out there, should I have more than one lender?
You tackle that one, so.
So, shoot it.
Years ago in banking, you were supposed to be loyal to one bank and they'd take care of you for life. And probably about 20 years ago, 15 years ago, that kind of changed. You should have in my opinion, one primary bank. But more importantly, like Steve said, you need to have a relationship with a banker. If that good banker leaves and goes to another institution, you probably will want to follow with him. But you need to have all your options opened. Banks are not loyal to their employees, as I've mentioned before, the way they used to be. Banks are not loyal to customers the way they used to be. So monogamy in banking is probably out of style, okay? And we're in Utah, so we got all kinds of marriage rules, right? Bill has a wife and a girlfriend, both.
Oh, ouch. I really don't. I just have a wife who is my girlfriend, but you've met her. If you're in that 1% standard deviation and you're a truly bankable customer, I agree with that. In most of my situations, if you're not traditionally bankable yet, lack of profitability, lack of leverage ratios, and so on and so forth, you probably need a couple different lenders because people tend to specialize as you get away from banking. You might have one lender for your equipment, one lender for your real estate, and one for your working capital because people tend to specialize as the risk continuum grows. They will always have a bank. I work with banks all the time. Many cases, a bank will bring me in a deal. They've got the relationships and all the different products, but they need working capital. The bank cannot supply it because they're regulated. Not that the banks are bad people, they're awesome people, but their regulators won't let them do the loan. So I'll come in there, do an intercreditor with the bank. Now they got two lenders. I'm lending on working capital, I intercreditor with the bank. They're handling everything else, and we have a great relationship. So in that case, you do need multiple lenders.
Yeah, I would say it all comes back again to relationships because, you know, at the end of the day, the goal is to facilitate your ability to do business and your ability to run and operate your business. And if you do business with a bank and not a banker, bankers can change. And frequently in large banks, they change quite often, as I'm sure many of you have seen in the past 5 or 10 years. If you don't have a relationship with a banker, I guarantee you don't have a relationship with a bank. You're just doing business with them. So develop that deep relationship. Make sure that that banker is working with you and facilitating your ability to succeed. That's really the key line. And that banker knows people. If you have issues on different things, they can refer you to different people. They can refer you to Bill, Phil, anyone else in a specialty industry to facilitate that.
Thank you. We're out of time, but this group came here. They have one question left that they want to ask. It might be the most important one. We're going to give you a little leeway. I just want a month and a year, but when will the next recession be? Thank you. Thanks to our panel for coming. Ask them later. I don't think they want to divulge it, but